In recent months, the global oil market has been caught in a web of uncertainty and volatility, driven by a complex interplay of geopolitical events and economic factors. Several months ago, a significant development took place as OPEC+ members, led by major oil producers Saudi Arabia and Russia, voluntarily agreed to decrease their oil output. Now, they have reaffirmed their commitment to these production cuts, extending them until the end of the year. This decision has significant implications for the global oil market, as it directly impacts the supply and demand dynamics. The production cuts have a critical role in influencing the price of crude oil. When supply decreases due to production cuts, and demand remains stable or increases, it can lead to a potential increase in crude oil prices. However, in recent times, the situation has become even more complex due to the ongoing conflict in the Middle East, particularly the daily escalations of the Gaza bombing. It's important to understand that there are two levels of production cuts in play here. In March of this year, Russia announced its intention to reduce its oil output through 2024. Later, Saudi Arabia and Russia extended their initial cuts through the end of 2023. These combined cuts amount to more than 1.3 million barrels per day, with Saudi Arabia contributing approximately 1 million barrels per day to these cuts. The OPEC+ group, consisting of 23 member nations, is set to meet later this month to discuss their future plans, including the possibility of extending, deepening, or increasing their production cuts. This meeting is prompted by the unknowns that lie ahead, with the escalating Middle East conflict being the primary concern. The Middle East conflict and the potential involvement of crude oil producers have raised concerns about the stability of the energy market. The International Energy Agency has suggested that Saudi Arabia and Russia may revise their planned cuts to stabilize energy prices. The fear is that if the war escalates and energy costs rise, inflation rates could surge uncontrollably, posing significant economic challenges. As of late, crude oil prices have experienced a surprising decline. While they were initially expected to remain steady or rise, the lack of a strong response from oil-producing nations has contributed to this drop. This situation is complicated by the ongoing uncertainties and the potential for further escalation in the Middle East. The World Bank has even warned that crude oil prices could surge to more than $150 per barrel in the event of a major escalation. The decline in oil prices could be attributed to the fact that we have not seen a significant decline in oil supply, despite expectations of a strong response from oil-producing nations. This has kept supply relatively stable, even as demand has fluctuated. As a result, the price per barrel of oil has gone through a series of ups and downs, with WTI crude oil falling from $90 at its peak in mid-October to $80 as of last Friday. These price fluctuations have brought crude oil prices back to almost their pre-conflict levels. The price of crude oil has a tremendous impact on the global economy, as it is the dominant source of energy worldwide. It is highly sensitive to a variety of events, making it a key indicator of economic stability. With the current levels of volatility and uncertainty, it is crucial to monitor how oil prices develop. The Middle East conflict is a major factor contributing to this volatility. The conflict in the region has the potential to disrupt the supply of crude oil and, in turn, impact global oil prices. The ongoing hostilities, especially those in the Middle East, are creating an environment of uncertainty that extends beyond the immediate region. Oil-producing nations, as well as global consumers, are closely watching these developments, as they have the potential to shape the future of the energy market. As we approach November 5, it has been announced that the oil production cuts will continue as planned. Both Saudi Arabia and Russia have confirmed their commitment to the voluntary oil export cuts through the end of the year. Russia, in particular, has committed to reducing its output by approximately 300,000 barrels a day until the end of December. These restrictions are in place to stabilize the price of oil, which has been volatile since the beginning of October. Now, let's take a closer look at the recent trends in oil prices. As of November 3, oil prices have witnessed a notable decline. and this trend has caught many by surprise. In October, oil prices exhibited significant fluctuations, with WTI crude oil dropping from $90 to $80 at its peak. The price of crude oil has returned to levels seen before the conflict in the Middle East escalated. However, this decline should not be taken lightly, as it reflects the ongoing volatility and uncertainty in the market. The World Bank has issued a warning that crude oil prices could skyrocket to over $150 per barrel if a major escalation occurs in the Middle East. This underscores the significance of the current geopolitical developments in the region and their potential global ramifications. The world is closely watching how these events will unfold and how they will impact the energy market. What makes the situation even more complex is the upcoming meeting of the OPEC+ group. The 23 member nations will gather to discuss their plans and policies for the next year. They have three main options on the table: extending their production cuts, deepening the cuts, or increasing their production. The decision they make will be crucial, as it will shape the oil market's trajectory. The primary reason for this meeting is the uncertainty surrounding the Middle East conflict and the risk of further escalation. The conflict has the potential to disrupt the oil supply chain, and oil-producing nations need to be prepared for various scenarios. The outcome of this meeting will have far-reaching implications for the global energy market and the world economy. As we delve deeper into the impact of these developments, it's essential to consider the potential consequences. The war in the Middle East poses the most significant challenge, with the high probability of escalation and further spread. If crude oil producers become involved, it could have a cascading effect on energy prices and, consequently, global inflation rates. In recent data, gasoline prices in the United States have played a significant role in the increase in consumer spending. As energy costs rise, consumers feel the pinch in their wallets, affecting their overall spending habits. Europe, in particular, is vulnerable to these price fluctuations, as consumer confidence is already at an all-time low, and economic growth is lagging. Europe's heavy reliance on natural gas exports, historically from Russia, has also become a major concern. Europe had attempted to send a message to Russia by seeking alternative sources of natural gas, such as the United States, Norway, and Algeria. However, this move did not yield the desired results and, in fact, backfired. The European Union's natural gas supply has been affected by the ongoing disruptions in Israeli gas fields. Until the conflict in the region reaches some resolution, Europe cannot rely on these gas exports. The Governor of the Bank of England has acknowledged the significant risk that energy costs pose to Europe's inflation levels. Energy prices play a pivotal role in balancing the efforts of central banks to tighten monetary policy in order to combat inflation. The uncertainty surrounding energy costs and their potential to skyrocket has introduced a new layer of complexity to economic decision-making. One of the key takeaways from the current situation is that energy prices, particularly the price of crude oil, are of utmost importance. They have the potential to counterbalance the efforts of central banks to fight inflation. The ongoing geopolitical events, combined with the uncertainties in the energy market, make it difficult to predict how the global economy will evolve in the coming months. It's important to consider the potential outcomes of the OPEC+ meeting later this month. The decisions made by these oil-producing nations will have a significant impact on the stability of the energy market. They must carefully assess the risks and challenges posed by the Middle East conflict and make informed decisions to maintain stability. The Middle East conflict is not just a regional concern, it has global implications. As oil prices fluctuate and energy markets respond to the uncertainties, it is crucial for nations and consumers worldwide to remain vigilant and adaptable. The path ahead is uncertain, and it will require a collective effort to navigate the complexities of the energy market and its potential impacts on the global economy. In conclusion, the Middle East conflict and the decisions made by oil-producing nations are at the forefront of global economic concerns. The stability of the energy market, particularly the price of crude oil, has a direct impact on inflation rates and consumer spending. As we approach the OPEC+ meeting, the world watches with bated breath to see how these developments will shape the future of the energy market and the global economy. Disclaimer: the views expressed in this audio content are solely those of the author and do not represent any specific source or organization. This content is for informational purposes only.